Due to a stronger than expected economy, rate cuts in the United States are likely to be slow and not necessarily sustainable. Such forecasts were reported today by Bloomberg. Experts at the German Commerzbank believe that a pronounced cycle of lowering interest rates by the US Fed in the next 2 years is hardly realistic. To some extent, these forecasts echo the comments of Michelle Bowman, who served at the board of governors of the Federal Reserve. The policymaker believes that reducing the key rate too quickly may lead to the need to increase it in the future. Michelle Bowman also warned that she is ready to vote for more rate hikes if inflation accelerates again. As a result, traders aligned their expectations with those of Federal Reserve officials, whose hawkish comments and cautious sentiment boosted the value of safe haven assets. In this context, Wall Street continued to grow, and Nvidia shares remained the most popular. Thanks to the rally, the S&P 500 index recorded an annual gain of 6.5% on Tuesday. In the New York pre-market on Wednesday, the index was trading lower at about 5,070 points. As for the robust U.S. economy, which Bloomberg mentions, there are still some alarming moments here. Yesterday's statistics showed a decline in consumer confidence in the United States and a record drop in durable goods orders since April 2020. House prices, on the contrary, jumped at the fastest pace since November 2022. The GDP data released today showed that the economy slowed to 3.2% sequentially. GDP rates below forecasts, waning consumer activity, and rising consumer prices are signs of a recession. It looks like the last round of the fight against inflation in the United States will be much more difficult than expected. The PCE price index, or price component of a GDP, rose by 1.5% to record level, but was below expectations for growth of 2.3%. This indicator measures changes in the prices for final goods and services. Thus, it's especially carefully monitored by the Federal Reserve when planning its future moves on the interest rate. Therefore, the US dollar index was again influenced by contradictory macroeconomic data, a fall in GDP and lower than expected price growth. As a result, the US dollar index went up inside the corridor between 103.80 and 104.50 points. At the same time, EUROZONE reports played a role in the decline of the single currency. The February indicator of economic sentiment in the EUROZONE, published today, fell to 95.40. However, it remained far from market expectations at 96.70. Service expectations and the consumer confidence levels have also dropped. At the same time, businesses in the Eurozone faced stubborn inflation, rising borrowing costs, and a weak external demand. Ahead of the ECB meeting on March 7, investors will likely prefer to wait for other important inflation data in the Eurozone and the United States. CPI flash estimates for Germany, France, and Spain are due to be published tomorrow. But in any case, markets now expect the Eurozone regulator to cut interest rates by less than 100 basis points. Caution and the global risk aversion are dragging down the euro-dollar pair for the second day in a row. The greenback has been extending its strength since yesterday. By the opening bell in the United States, the euro-dollar pair traded in the red within the intraday corridor between 1.0820 and 1.0830. However, the single European currency shifted to the lower border of the range in which it has been stuck for about a week. The situation has not changed fundamentally, and the trading range remains within 1.0800 and 1.0850. Any further decline is likely to find decent support near the 1.0785 area. On the other hand, the 1.0850 area appears to be acting as an immediate resistance level. If it breaks through, the currency pair may try to hit the round level of a 1.0900. Meanwhile, cautious market sentiment creates the preconditions for the euro's losing its bullish momentum. The level of a 1.0800 may well turn out to be a strong support for the sellers. Oddly, despite the US dollar's advance, oil prices moved higher, defying expectations. Over the past two sessions, oil prices have increased by about 3%, and they were pushed upward by geopolitical risks in the Middle East. In addition, investors are now awaiting a March decision from OPEC and its allies on production prospects for the next quarter. At the same time, the market reaction to the American Petroleum Institute's data on oil inventories was also surprising. In response to reports of an unprecedented increase in the United States reserves to 8.4 million barrels. Oil prices also went up against the logic of the market. Perhaps the reason is that oil has been trading in a wide range from $81 to $84 per barrel for almost a whole month. And now the price has simply moved closer to its middle. In theory, we can expect further movement towards the upper border. Brent crude opened today above $83 a barrel, an obvious pressure from the sellers in the area of 83.5 enabled a pullback. Then the bulls took the upper hand. In such a situation, the trading range over 81.00 and 83.80 may swing even wider and remain on the market for some time. You have watched Market Review by InstaForex analyst for Wednesday, February 28. Subscribe to InstaForex TV channel and we keep you updated on recent market developments. Don't miss our video. Your feedback is appreciated, so see you online tomorrow.